Our next guest expects a slight reacceleration for the July number, but says any inflation improvement doesn't mean a soft landing and expects a recession by later this year or early next. Joining us now is former Federal Reserve Vice Chair, PIMCO Global Economic Advisor, Rich Clarida. It's good to see you, Rich. Welcome back.
Hi, Sarah. Good to see you.
So what are you expecting tomorrow? You think we're going to have a problematic number?
You know, we're looking more at the core number. The headline number could actually pop up just because of the base year effect. But we got a good print on core in the last report, and we expect a similar print. You know, we could be wrong, but a core number in the range of, say, 2.5% or so annualized. And that would certainly be better than we've been having.
So what will that mean for September, for the Fed, or November?
You know, I think the Fed is truly data dependent now. I think that the chair, for example, in his press conference emphasized that they could pause in September, they could hike. I think they'll want to keep their options open. In particular, Sarah, they don't want to declare mission accomplished too soon, but also they can't be tone deaf. I think they do need to acknowledge that the data is improving, especially on the price inflation side, less progress on the wage inflation side.
So why wouldn't they just keep hiking? Market's not expecting another hike for this year. If there's still work to do on inflation and they haven't destroyed the job market, far from it, third quarter GDP from Atlanta Fed is tracking over 4%. Yeah. Why not just keep going?
Well, you know, Sarah, I tend to agree with you. And if I were there, I would be supporting getting another hike in this fall. But I'm not on the committee, and some of the rhetoric, including recently from John Williams and Pat Harker, have indicated that they're receptive to the idea that they could be done. But I think you raise, as usual, a very important point. You know, inflation forecasting has not had a good track record in the last 3 or 4 years, including mine. And although there's a case for forward-based policy, you know, right now I think I hope they do look for inflation actually to come down durably and stay there. And so I think it's too soon to declare mission accomplished.
Although, Rich, you were asked about a month ago about some of the market wagers about a March cut, and you did suggest, at least at the time, that a cut in March or an indication that the March meeting would involve cuts makes some sense. You still feel the same way?
I do, and I'll tell you why. Under the Fed's First of all, remember the Fed baseline projections at the June meeting had that additional hike in the SEP dots. Indeed, the vast majority of the committee thought they would need that additional hike. And under that projection, they had inflation, core inflation next year falling into the twos. And so I think if we're sitting at the March meeting with core inflation on a year-over-year basis in the twos, I think they will begin to entertain cuts. But that's only conditional on getting there. There's a lot of road to travel between here and then. But I think under that baseline outlook, that's a sensible thing to start thinking about for next spring.
So does that mean we're in recession by then?
Well, I think the odds of at least a technical recession as declared by the MBER are more likely than not. You know, historically, whenever the unemployment rate's risen by more than half a point, it's been declared a recession. My sense is that we're going to need to see some modest rise in unemployment to get wage inflation into the ballpark consistent with the inflation target. I'm aware that there are a lot of folks on the other side now who are calling for a very soft landing without a recession. I'm in, Sarah, what I'd call a softish landing camp, where we'll get some rise in unemployment, say into the mid-4s, as what we're going to see in order to get inflation into where the Fed wants it.